Walgreens Valuation Slideshow with Explanatory Expansions by Robin L. M. Chung. MBA. The following case study was completed in winter and spring 2002 as part of the requirements for an advanced course in financial statement reporting and analysis in partial fulfillment of the requirements for my Master of Business Administration at McMaster University in Hamilton, just outside Toronto, Ontario. We were to apply our learnings in whatever way we wished, using whatever financial statements and models we wished, kind of like real life, not restricting us to a specific toolset, but then not giving us hints as to what tools to use either for our chosen firm and our chosen industry. In my case, I chose Walgreens, an American retail pharmacy chain. My prediction played out so well that even after a decade, the actual stock price of $27 per share landed exactly between my upper and lower bounds, defined as EBO as the lower bound, at $23.41, and the discounted free cash flows model as the upper bound, at $30.74. I caution readers, however, that despite my comfort or adeptness with any given prediction, that fundamentally the world suffers from two, yet still fatal flaws that cannot but continue to accrue negative consequences that, at some point, will break the proverbial camel's entire life force. Society, without reversing these bad habits and also internalizing the impact of the corrective function of consequence that karma refers to, must eventually collapse and be numbered along with the Atlanteans, Lemurians, and now, most recently, Göbekli Tepeans. The economy, psychology, even medicine and society in general, are composite constructs representing complex interactions comprising feedback loops and attractor states that make reductionist approaches that attempt to represent these realities as a sum total of individual variables are more coincidentally correct than we take credit for. A holistic proxy that reduces to a net outcome when used as a directional indicator in a recursive servo type system is even likely to be more successful in the long run than misplaced confidence in any number of variables, of even the absolute highest quantitative validity when examined in isolation of the remainder of the variables, and without specific contextual setting. And how many of you did not even stop to think that the common sphygmomanometer, the so-called blood pressure cuff, doesn't even measure blood pressure? Think about it. How can it be measuring anything other than air pressure as it deflates, which is then used as a proxy to blood pressures due to a separate phenomenon characteristic of laminar and turbulent flow in the blood vessels inside your arm? With that all-important caveat out of the way, here is a breakdown of my price prediction and the details of why it was reliable to the extent that it could be, over a decade-long period, to predict a specific price within a narrow range. You'll note that this is dependent on quantitative fundamental analysis, with zero technical analysis taken into account. Contrast that with the overly simplistic price prediction explanations you'll often hear debated and thrown about the internet. Let's begin. Slide 1. My 2002 Walgreens 10-year price prediction. Welcome to this walkthrough of my Walgreens 10-year stock price prediction, crafted during my MBA in 2002. Back then, I employed two valuation methods: discounted free cash flow (DCF) and the Edwards-Bell-Olson (EBO) model to predict Walgreens stock performance for the next decade. These models differ fundamentally in their assumptions, mechanics, and applicability. Let me briefly explain. The DCF model works by projecting a company's future cash flows and discounting them back to their present value using a discount rate, often tied to the weighted average cost of capital. This model is particularly suited for businesses with predictable cash flows and growth trajectories, as its accuracy depends heavily on reliable forecasting and appropriate selection of the discount rate. In contrast, the EBO model is rooted in accounting-based valuation, focusing on the relationship between book value, earnings, and their respective growth over time. It incorporates the idea that current book value, adjusted for expected future earnings, captures the intrinsic value of equity. The EBO model is more conservative, especially in industries where competition or external shocks may impact growth rates, as it ties valuations more directly to accounting fundamentals rather than future market expectations. Slide 2. ChatGPT's evaluation of my 2002 prediction. Fast forward to today. Revisiting my analysis with ChatGPT confirmed that my predictions from 2002 were remarkably accurate. The stock's 2012 actual trading price 10 years later fell precisely between my lower EBO estimate of $23.41 and my upper DCF estimate of $30.74. Here's why. The DCF method captured Walgreens' robust growth potential during the 2000s, driven by demographic shifts such as an aging population and increasing reliance on prescription medications. These trends predictably translated into expected and growing cash flows, making DCF an effective tool. However, the EBO model's conservative baseline, anchored to book value and residual earnings, provided a safety net against overestimating growth in a competitive sector. The contrast lies in their sensitivity. DCF emphasizes market potential, while EBO emphasizes fundamental resilience. Why did these models work so well in this context? Walgreens in 2002 operated in a retail pharmacy sector that combined steady consumer demand with limited technological disruption. This allowed for relatively stable forecasts, which is crucial for both models. However, the key difference is in their assumptions. DCF assumes growth continuity, while EBO accounts for potential disruptions or underperformance by emphasizing tangible equity and accounting conservatism. Slide 3. Key takeaways from my valuation process. Here are the key takeaways. Understanding context. The retail pharmacy sector in the 2000s was driven by macroeconomic and demographic trends. An aging population and increased healthcare spending created steady demand for prescription drugs, while Walgreens benefited from its geographic expansion and operational efficiency. Model selection. The DCF model excelled in capturing growth potential, making it ideal for a company like Walgreens with clear demographic tailwinds. However, the EBO model's focus on fundamental accounting metrics provided a check against over-optimistic assumptions, especially in a competitive sector with pricing pressures. Mathematical foundations. Because of the widespread availability of financial information and trading services online that was not nearly so available in 2002, the popularity of trading self-directed portfolios of crypto and stocks has exploded. However, a rigorous and thorough understanding of the factors contributing to the price action people see is not nearly commensurately well-informed. Because of the years of structured, disciplined accounting and finance coursework that is underrepresented in the more sleek and sexy portrayals of trading online these days, technical analysis, which is almost a misnomer in that it connotes a technical component that refers only to price movements representing, effectively, the composite net effect of traders' psychology and herd dynamics without even hinting at the underlying fundamental attributes of a firm. I believe the majority of retail, and even institutional, traders are trading on axiomatic beliefs that are not natural laws. Effectively, traders are ripe for a black swan experience. Constructs like support or resistance levels exist only because they have been, to now, conventional but otherwise arbitrary price levels people felt comfortable with using and attributed significance to them. Yet they are analogous to synchronicities in that they only took on significance because a large number of people considered them so. A single large investor or a large number of similarly inspired individual retail investors could easily demonstrate the problem with depending on arbitrary convention as if it were natural law. This is the problem with being self-taught in general. Without a guide who already knows the landscape, then it is impossible for us to know not only what we do not know, but the relative quantitative contribution in context of what we do know. Yes, a pre-existing paradigm does introduce the possibility of becoming inculcated in it without a chance to see other paradigms, but being informed of it can reduce that danger. I still believe that the open door that knowing more possibilities and knowing them in relative contextual priority is conceptually far better overall when one is constantly checking for blindly adopted paradigmatic influences than not to have known and potentially unbounded set of possibilities not considered due to no even being aware of their relevance or existence. The DCF formula relies on summing discounted future cash flows. Where is the cash flow in year? And is the discount rate? The exponential relationship arises because cash flows further in the future have proportionally less present value due to compounding. The EBO formula, by contrast, links equity valuation to book value and residual earnings. Where is the residual earnings, earnings less a charge for the equity cost of capital? This structure ensures valuations remain anchored to tangible fundamentals. Slide 4. Epilogue. What actually happened, 2002-2012. Now let's compare my predictions with reality. Walgreens' revenue grew steadily, though slightly below my initial assumptions. This reflected increased competition from CVS and the rise of online pharmacies like Amazon. Despite these pressures, Walgreens' stock price in 2012 aligned closely with my predictions because the demographic-driven growth assumptions held true, even if sector competition tempered revenue growth. Both models effectively accounted for different risk factors. DCF captured growth opportunities, while EBO guarded against downside risks tied to competition and market volatility. This alignment underscores the importance of selecting complementary models that address different facets of market dynamics. Slide 5. In retrospect, why this matters? This analysis represents more than a prediction. It's a demonstration of how financial models can be tailored to specific industries and contexts. For me, it reinforced the importance of combining quantitative rigor with qualitative intuition. Quantitative rigor. By understanding the mathematical foundations and assumptions behind each model, I was able to select and adjust parameters that aligned with Walgreens' specific operating environment. Qualitative intuition. Navigating the sociological and market dynamics of the time, including consumer behavior, competitive pressures, and macroeconomic trends, provided the insights needed to fine-tune these models effectively. Ultimately, this exercise taught me to view models not as definitive answers, but as tools to explore and understand complex systems. I hope it inspires you to integrate both mathematical precision and contextual awareness in your own analyses.